Well, we've got an amazing show here, the Wall Street Hackers, and it is my distinct pleasure to introduce the host of this show. So, definitely looking forward to this particular show. It's one of our most popular shows here on Pod TV, and it's definitely, even when it was IBM TV, it was a very popular show as well. And some people are saying, hey, why watch The Hacker? Well, you get some interesting stories, you get stories you won't get elsewhere, and you also get the dividend pick of the week, and you can catch a new episode every Thursday at 1 p.m. right after Barbara Smith and her show Empowering You, and all along those lines. So definitely it's my pleasure to introduce Peter Bennett. He's got all kinds of amazing thoughts and amazing things going on, and he's got a BA in economics from UCLA, a law degree from the University of Miami Law School, and an MBA in finance from New York University. And he's also worked on Wall Street and in finance for 17 years. So he's done a lot of amazing things. And I won't even hold it against him that he lives in Connecticut, because as many of you know, I am a Marquette graduate, and Connecticut is one of our major rivals and seems to knock us out of contention just about every year. But right now we're starting off 5-0 and just finished beating up on Purdue. So I'm feeling a little bit good right now. We'll see if we can maintain that momentum when we go against Georgia. So I won't hold it against you that you're over there in Connecticut, which is one of our major rivals and is a national championship kind of team and everything. So I won't hold that against you.
No, that's okay. That's true. Connecticut does have a pretty dominant team in the last few years, and I believe men's and women's too. So thanks for the great introduction as always, Mark. You do a great job. I appreciate it. So welcome, audience, to Wall Street Hackers, November 21st, 2024. You can catch a new episode most weeks, starting at Thursdays at 1 or Saturdays, depending on your distribution channel. But that said, next week will be, of course, off for Thanksgiving, but we will return on Thursday, December 5th. So first, our market report. After the initial surge in the market, the S&P 500, the market has been declining a bit since November 11th. As we said last week, and we've been saying, dodging the bullet of electing the first socialist and progressive president doesn't actually assist the economy or any of the companies directly. And there are definitely issues remaining in the economy, to say the least. The Trump administration is certain, and I am positive, to do some positive things for the economy, but that doesn't mean all the results will be effective. What they will do is they will cut regulations, which are desperately needed, cuts in regulations, and also cut government waste. And people have been talking about government waste for, I don't know, ever, or at least certainly since the 60s, 70s, 80s, whatever. I mean, there's just so much government waste. We hear about it, these crazy stories of expenses. And so that will help the economy. But unfortunately, it doesn't take a second or a minute to turn a ship around. And the government is a very big ship in the economy. And there are major issues he's inheriting. First, as we are always pointing out, there is $125 trillion in U.S. debt. That's a pretty solid estimate, as based on the opinion of David Walker, who is the three-time controller of the United States, and also control of the currency. And also, he is on Economics Monday, an interesting economic show. So it's not $35 trillion, and everybody's concerned about the $35 trillion and talking about it pretty much every day all over the news. The interest on this debt, this unbelievable debt, is piling up, compounding, and it's already affecting the federal budgets and straining them. Number 2 point is Biden's anti-fossil fuel policies, which at least in the short run were really bad for the environment. We discussed that in other shows, leave the country in a situation where we are not in the energy position we should be. And energy projects take 5 years to 7 years to come to fruition. So even if we have a perfect energy policy, it will obviously help, but these things take time to turn around. And so energy won't necessarily be helping in terms of inflation. And there are issues with stagnating production, not necessarily falling, but stagnating shale oil production in parts of the United States. And so that may be a big issue too, energy prices and possible energy increases, certainly. And also, we've talked about this a lot, is Wall Street has and continues to believe absolutely that the war against inflation is over, or many on Wall Street, I should say that, and we are going to have a soft landing. There are no chance of recession, or it's unlikely. There's problems with that position for sure, the certainty. Number one is there's still 8 million unfilled jobs in the United States, and that means labor costs are likely to rise and certainly not fall. But here's a really fascinating chart, and you won't be able to see everything, but I'm going to hold it up and talk about it a little bit. But this is, once in a while I come across a chart, because I read a lot, where I go, wow, that really says a lot, and this is important. So this is the chart. I'll hold it up. And what it's about is unit labor costs. Let's see if I can get a little closer there. Okay, and recessions. So if you want to take a screenshot, maybe you could do that. I don't know. But so what this is saying is there's two real key points, takeaways from this, and they're really significant. Number one, unit labor costs have been rising since 2020. Or let me take a step back. It shows that since 1948, every time unit labor costs rose substantially, a recession either quickly followed or was actually happening at that time. Again, you could see this chart. There's rises in the unit labor cost, the black line, and then boom, recession, pretty much as systematically. So that is an amazingly stable chart in terms of its what it's showing. So first of all, so what this says is two things. One, unit labor costs have been rising, if you look at the end of the chart, since about 1920. And since 2020, and they've been rising in 2024. So that's the wrong direction. But also the recent rise in unit labor costs are hitting the level where many times there was then a recession. So that's not inspiring too much confidence in terms of, if you believe that, the likely results from that chart. Also, getting back to the markets, the bond market is indicating some kind of fear for certain, and it's probably fear of inflation. Yesterday, you could get about a 4.6% guaranteed rate, no risk return, except for risk of inflation, of course, or selling before maturity. But you could get a no risk return of 4.6% on 20 or 30-year Treasury bonds. Now, a few points about that. One, those bonds compete with the market, so that could put a lot of pressure on the market. And those bonds are state tax-free, which means they really look better than muni bonds right now, but you can't come close to that. There have been times when muni bonds look better, but right now treasuries look much better at 4.6% for a lot of investors. So that's creating both competition for the market, and maybe that's why the market's stagnating because it flows in towards bonds, but also it shows that the bond market is not convinced. I am keeping this chart for the future. Okay. Quote of the week. And this comes from the Invesco US, a recent Invesco US report. The Federal Reserve is cutting because it can, not because it has to, with 150 basis points in cuts expected from now through 2025. The supply of investment-grade credit is light and the demand is strong, as I was saying, coming domestically from retail and institutional investors and internationally from Asian and European investors. So apparently, retail institutional investors and international investors and your Asian and European are all interested in having some demand for these bonds at these rates. Again, maybe concerned about inflation or the future. It's hard to say why. So my points would be, one, the Fed needs to lower rates. Not I'm telling them to, although they do need to. They need to lower rates to make housing more affordable and to lower the interest on the almost unfathomable U.S. government debt. On the other side, there's a big challenge in possibly restoking of inflation, or a very likely scenario that I think is the most likely is a leveling off of inflation at high rates. And that could cause a stagflationary environment. So that's what my number one guess would be. But you can never be certain, so you kind of hedge all bets. Okay, what to do? As always, we believe in generating income through the use of dividend stocks and dividend growers that our studies show, and our studies cover about almost 200 years. These stocks outperform the markets. My favorite study showed for 20 years to 2022, dividend growers and dividend initiators outperformed them, and dividend payers outperformed the general stock market by 2 times for dividend payers and 3 times by dividend growers and initiators. And another study back about 100 years from Morningstar said they also outperformed dramatically. Also, studies show REITs often outperform the market, and we like selected MLPs where there have been some very high historical returns. We also, of course, look, especially these times with these macro environments, this macro environment, we also look for defensive balance sheets, companies with high cash flows, and especially in defensive sectors and in allocations that diversify the positions. So that's it's been a good strategy in the last few years for us and our investors. And if you don't believe that, you can quickly look at MPLX, where I at one point was advocating for over a 25% allocation. I've cut that back down to 12 just for diversification, but I still like MPLX a lot. You pick up a chart of MPLX in the last 3 and 4 years, and also consider that it was paying over 10% dividends. It's still paying over an 8% dividend, tax advantage for some U.S. investors. So 3 most interesting stories of the week. Sorry, 1 minute. Sorry. Someday the Democratic Party may realize they need to widen their information sources from an almost clueless mainstream media. I mean, they are so clueless, the stuff they say. Many Democratic positions have constantly repeated things that the media is saying that are patently untrue. And they seem to be believed. And if Democrats and liberals would at least vary their viewership a little bit, they might find that they're relying on a mainstream media that is misleading them in many ways. Mainstream media is not supposed to be making policy. If you just widen your viewership, and I base this too on, I don't know that any Democratic politicians personally, but I do know some of my friends and relatives who are Democrats. And by the way, I am not a liberal or a conservative. I have my own opinions, but depending on the issues. But my point is that several of them have said, "Oh, I won't look at Fox News Daytime, Fox Business, The Post." They just don't want to hear it. They disagree, and they don't want to hear anything that varies. And so my guess is that many Democratic politicians are the same way. If you're getting all your news from MSNBC, which, by the way, is about to go into turmoil, I'll cover that next week, or CNN, then maybe you're just getting a lot of false information. A perfect example, by the way, is the position that crime is not a problem in America and that illegal migrants are not having any impact on crime in America. Kamala Harris argued that in the presidential debate, that there's no increase in crime and immigration, basically saying immigration was a problem. And then the moderator from ABC, who had promised not to interfere in the election, actually debated Trump, and even worse, debated Trump with a false point, because he said an FBI report said that crime was down in America. But if you actually review that FBI report, you discover that it was highly flawed at the time, because many blue cities and blue states had not even put in data. So it was a very flawed report, and it was a misleading story. So here's some quotes from the New York Post about New York City. Quote, across New York City, recently arrived migrants are flooding the criminal justice system at far higher rates than public officials have acknowledged. Police sources shared a staggering estimate that as many as 75% of the people arrested in Midtown Manhattan in recent months for crimes like assault, robbery, and domestic violence are migrants. In parts of Queens, the figure is more than 60%, sources their estimate. On any given day, Big Apple criminal court dockets are packed with asylum seekers who have run afoul of the law. Quote, a Midtown officer said, quote, I would say about 75% of the arrests in Midtown Manhattan are migrants, mostly for robberies, assaults, domestic incidents, and selling counterfeit items. As a footnote, I really don't blame the migrants at all. I mean, I blame them a little bit, but look, you come from another country, you don't have a source of income, you're desperate, and you know, I mean, it's a difficult situation for them. It shouldn't have been set up this way at all. But I mean, I'm not saying the crime is right or the situation should have been happening at all as usual. So a lighter and a really interesting to me, literary and historical story that Lord of the Rings fans will especially appreciate. So in 1785, a farmer stumbled on a gold ring with the inscription Senesciensis on it. It also had both pagan and Christian symbols, which are very rarely found together on anything. The farmer sold the ring to a collector, and the ring was studied for 143 years. In 1928, an English history professor, you can guess the name, named Tolkien, was part of a group that was studying a tablet, and the tablet was inscribed in Latin. The message described the theft of a golden ring and said the thief had the name Senesciensis. Analysis of the tablet showed it was created around the 4th century. So ring with inscriptions and tablets in Latin and pagan and Christian language on a ring. Sound familiar? In any case, personally, I only wish I could find the other 6 rings. Most interesting story of the week, number 3. A supersonic aircraft named the, quote, Son of Concorde neared Mach 1, the speed of sound, in a successful test that could lead travelers flying between New York and London to just over 3.5 hours. It was the 7th of 10 flights since March. Both American Airlines and United Airlines have inked deals to fly the groundbreaking planes. And so perhaps if this is successful, the company itself, by the way, has announced that they expect a, quote, full-scale engine core to be operational by the end of 25. So if this comes to fruition, then we really could be seeing flights between New York and Rome or Tokyo to Vancouver in about 4.5 hours. We will see, but it could be a small world after all. I can't resist throwing in some of these jokes, even though they're not that funny. Anyway, back to serious stuff. Dividend pick of the week. First, disclaimers. Wall Street Hackers is for entertainment only. There are no guarantees on any investments, suggestions, because there's never any guarantees on any investments, basically. These are only our opinions. Consult your financial advisor. A few notes about past suggestions. My perfect scenario is to buy a stock that produces income and hold it forever, because 1, I don't have to pay capital gains on it or any extra taxes, and 2, I don't have to do the work to try to find a substitute. But in this case, I made 3 very small changes because they were extremely small allocations as recommended in investments, all Canadian, but that's just a coincidence because of the election. SPGYF and HMENF are Canadian oil producers where we had under 0.25% allocations. And I'm probably going to buy back SPGYF. I'm not as confident in HMENF at all. But I sold them at small break even, maybe a little profit on one, and I think a loss on the other. But whatever it was minute, fraction of a fraction. But my concern is after the election now, possible impacts on Asian energy demand and Chinese energy demand in terms of tariffs and trade wars. And we will be discussing trade wars as the topic of the week. And also, I sold another very small allocation to NTR Nutrien because they sell fertilizer and they're Canadian. But I expect that the Ukrainian war, I wouldn't be surprised if it's settled within the next 2 months. It could have been settled. I said it a long time ago. Zelensky was not giving in an inch of ground, and he needs to be forced to, and he's not wrong, obviously, in terms of the overall picture, but he needs to be forced to compromise. This has gone on too long. There has to be a settlement. All parties have to be forced to compromise. And I think maybe they're ready now. So that would impact the fertilizer market. Nutrien is one I would get into again, but for now, I don't even need it, and I'll wait. Dividend pick of the week. TELUS, TU, where we have a small allocation, again, under 0.25%, but here I'm adding to more in the future. I just don't have room in my 401k right now, and that's where I keep it. I keep it in my 401k because as a U.S. investor, I'm subject to 15% withholding taxes, and I don't want to pay, interest and state taxes on the federal and state taxes on the dividends, and then pay it on the 15% I don't even receive from because it's going to Canada. So I'd rather have it in my 401k or in an IRA, and maybe I'll add more later. I wouldn't be surprised. TELUS is a Canadian-based communication company providing mobile phones and internet and television services. What I like is a 7.4% dividend yield, and I like the price over cash flow, which we always look for, of 6.5, which is a 15% free cash flow yield, a reasonable debt over assets ratio of 0.51, and a very nice dividend growth history. In 2014, it was paying 20 cents in December, and now in December it will be paying 40 cents, or it is paying 40 cents. So it doubled the dividend. You know what? If I have 7.4% dividend yield and it doubles in 10 years, I can definitely like that. And again, I'm going to be watching that one. Panel discussion of the week, and we'll bring Mark back. We have about almost 7 minutes, which is a little better than usual because we're always. Hey, Mark. So we're going to get into a discussion on tariffs, which are a very complex subject. The question of the week, and then we'll do the background, and then we'll each take turns. Are tariffs effectively sales tax? Background. During the recent presidential elections, the mainstream media, I wrote it twice, so I read it, often said Trump would be putting in a huge sales tax, and Kamala or her proxies ran ads saying Trump will be putting in a 20% sales tax on consumers. It certainly isn't that simple. On the other hand, President Biden's administration not only kept the prior Trump administration's sales tariffs, they actually expanded those tariffs, despite what everybody else is on the Democrat side is saying. They increased the tariffs, so that says something. On the other hand, again, some analysts are arguing that Trump's new trade war will upend economies, quote, upend economies, and hurt international trade, which it certainly would impact international trade. And some investors are very concerned about the risk of tariffs of up to 60% on goods from China, as well as possible universal tariffs of 10 to 20%. But I don't think there will be universal tariffs at all. I think there will be targeted tariffs, though, for sure. So I have my conclusions. We have about 5 minutes. So Mark, if you take 2, I'll take 2, and then we'll see what we do with the other minute. Go ahead, Mark.
Well, one of the things I got interested about tariffs, and I kind of mentioned it to you earlier and everything, is that some people are saying, and that you would have a better understanding than I do because you're in the economic field that and they've even talked to employees or employers, and they have agreed that this notion that if the sales tariffs are given to a foreign country, that it's not the country that's paying the tariff, it's actually the employers that are putting the cost back on their goods in order to help pay for the tariffs and all along those lines. So I've heard this argument several times, and I'd love to hear your thoughts around this, because the notion is that, say we put tariffs on Chinese goods, then companies that have to get those Chinese goods, that they will then turn around and put that cost back on those products. And that's where a lot of people are frustrated with the notion of tariffs.
Okay, very good. Thank you. You actually used less than 2 minutes, which my co-moderators sometimes use too much. Thank you. Appreciate that. So I'll go, and then we'll probably have hopefully a little more time. So my conclusions. One, it's all about implementation. So tariffs can be a force for, it sounds almost like Star Wars, but tariff can be a force for great good or great harm. And it all depends on how they're implemented. So when I say implementation, it is how they're implemented, how they're structured. It's the speed of implementation, and it's also who they're implemented against. So it depends what happens there. We don't know how this will unfold. Point two is tariffs are a huge negotiating tool for President Trump, and he is a good negotiator. You may like him, you may not like him, but there's no doubt he's a great negotiator. If you don't think he's a good negotiator, look up or Google basically the Woolman Ice Rink in New York City, which was a public ice rink where there were, a decade of delays, and he came in and he had that thing built at a fraction of the cost in 1 year and helped the city, and he negotiated a great deal. So he likes to negotiate, and this is a tool for him. And a recent example of at least how he's using it as a tool is he recently, just maybe the day before the election, said that if elected, he would immediately slap a 25% tariff on imports from Mexico if they didn't stem the flow of illegal immigrants. I mean, agree or not agree, and I think we need to stem the flow to a good extent. That is that's the use as a negotiating tool. So again, it's all about implementations. 3, tariffs are complicated, and in the short run, they definitely could cause disruption. Definitely. They could just cause increases in consumer prices, and there are trade-offs there. Of course, other effects of Trump policies like cutting regulation may help offset some of those negative effects, but there are inflationary effects. There will be inflationary effects in the short run to that. In the long run, though, this will have more and medium run, I expect more positive effects because, one, this will shift production to countries that have fairer trade policies, not to mention force ones with unfair trade policies to, negotiate in better faith. But also, it will very likely bring manufacturing back to the United States, making us less reliant, bring jobs back. And and also from an environmental standpoint, one of the reasons that the environmental policies of the Biden administration were doing a lot of harm is forcing manufacturing overseas where they don't have environmental regulations or have very weak ones. So bringing back is a good thing, but I'm not sure they won't just shift to other places like maybe Vietnam or Thailand or in Mexico especially. But there's inexpensive labor in other places, and so we'll see how everything flows. Mark, we have actually about 40 seconds.
We'll see how it flows, like you said. I do know that earlier on World Edition, we talked about the Mexican president, and apparently she is having a meeting with her folks because it is a lady president, and she is going to be talking about tariffs and regulations, and even says that she welcomes some of those folks that are coming to Mexico from the U.S. back to Mexico. So we'll see how this all plays out.
I didn't know that, Mark. I'm going to have to look up further in that article, on that topic. So that was actually perfect timing. Thanks for watching, everybody. We'll see you in the week of December 5th. As Kim always says, get healthy and get wealthy. See you soon. See you, Mark.
See you. Oops. I gotta hit the right button. Oh, there we go.